Everyone, I would like to welcome you all to our 2014 Market Outlook webinar. It's kind of hard to believe that another year has come and gone, but I think the reason it seems so fast is because I'm getting old and the years seem to fly by these days. 2013, as you all know, was a remarkable year for the market. Despite all the turmoil throughout the year, beginning with the fiscal cliff threats and the sequester, and finally the government shutdown, investors still enjoyed significant returns, and assuming they stayed in the market, they were pretty happy. We can't guarantee that you're going to have another year like that, but we're going to sort out 2014 today. So to get some perspective on how 2014 might play out, I'd like to introduce Patrick Morrell. Most of you have met Patrick either in person or through our webinars, but for those of you who haven't, he is our investment analyst responsible for investment analysis, monitoring, research, and our due diligence. He's a certified investment management analyst and an accredited investment fiduciary, as well as being a candidate for Chartered Financial Analyst or CFA Level 2. And not to mention that as nerdy as all of that sounds, he actually has a personality. So I would like to turn it over to Patrick. Take it away.
Thank you very much, Corby. Thank you, Brady. I appreciate being invited back on the call, and like to welcome all of our repeat callers, those that tuned in last quarter, those that are tuning in this quarter. Really look forward to unveiling our thoughts and opinions on the markets over throughout the course of 2014. We're looking right now at the cover page to our presentation. It might look eerily similar to a farmer's almanac, and I think that's the theme we went with this year. Really what we're trying to do is provide some market and economic forecasts and really give you, a bare bones look at what we think is going to happen both in the economy, within stocks, within bonds, and so on. So without further ado, I'd like to flip forward right to the key components of our outlook for this year. Keep these three components in mind as we progress throughout the rest of the slides. It is our opinion that 2014, from an economic standpoint, is going to be a much better year than 2013. Really, over the past decade, the U.S. economy has grown in terms of GDP, gross domestic product, at a rate of about 2% a year. That 2% rate is slightly lower than the long-term average growth of our economy, at about 3%. So our outlook for 2014, based on numerous data points that we will cover today, arrives at about an economic growth rate this year, 2014, at 3%. So we're getting back to that longer-term average. And there are several factors that I will highlight that will support a higher growth rate this year. A higher growth rate on GDP, a stronger economy, will ultimately lead to, in our opinion, another good year for stocks. So we are certainly not anticipating a 32.4% return on the S&P for 2014 as we did in 2013, but we do believe that some expansion in the price-to-earnings ratio, some additional growth on corporate balance sheets will support a stock market return in the low double digits. We're estimating anywhere from 10 to 15%. The bond markets, on the other hand, are not in the best position for investors, in our opinion. We have seen a slow rise in yields over the past year, and really that is off the back of the Federal Reserve reducing its bond purchases, putting less money into the markets, and ultimately keeping yields down below 2% where they previously were on their lows. So we're expecting yields to slowly rise in the bond market. For those of you that aren't familiar with the yield to price ratio, as yields rise, that means that bond prices are falling. And so a rising yield over the course of this year means that on a nominal basis, on a dollar basis, the purchase price of our bonds is actually declining. We think another reason that the economy and ultimately the stock market are positioned for a good year in 2014 is the investor. We believe that overall the investors in our markets are a lot more confident and a lot calmer than they have been over the past 5 years. And we think that given that notion, investors are going to focus more on the fundamentals of investing rather than trying to guess what the government's going to do next. Corby had mentioned in his intro there were a couple of government issues that arose in 2013, some fiscal battles, some debates over taxes, some debates over budgets, and ultimately a government shutdown. We think that investors are going to start to look less at what the government's going to do next and look more at the companies they're buying and the sectors they're investing in. So with all that in mind, a growing economy, a good year for stocks, and a flat or negative year for bonds, I'm presenting to you our outlook in one snapshot if possible. On the left-hand side, we see, again, GDP growing at about 3%, stock market returns between 10 and 15%, and the bond market a little bit bearish with flat returns, maybe even negative returns depending on the maturity of your bonds. But we believe that amongst all of this, there are certainly a lot of opportunities for investors to have another great year in both their 401ks and personal investments. Under the sowing seeds column here, some emerging trends that we believe are plausible for this year. We think that international markets and international stocks in particular are going to have a stronger year than they've had in the past. We look at both developed and emerging markets internationally. We think that stocks in the U.S. small cap, mid cap are primed to do well. If we look at investments that are in full bloom or longer in the maturation process, we think U.S. large cap stocks are going to continue to perform well, but are kind of in stride with where they need to be. It's particularly cyclical stocks, stocks like you see industrials, manufacturing, more of the nuts and bolts of our economy will continue to perform well.
Hey, Patrick,
yes.
Sorry to interrupt, but for us old guys, probably just me, will you zoom that in just a little bit? And then for the benefit of anyone on the right-hand side of your screen also, you'll have access to asking questions. I forgot to leave that part, so go ahead and put questions down if you have them. Sorry, Patrick.
You know what? I'm actually going to go through each one of these individually. I'm having a hard time zooming the slide, but I will go through each one of these bullet points in its own slide.
No problem.
As I move forward. So with that kind of context and that frame of mind, let's start to look at some of the things that we think are primed to grow in 2014. I did suggest earlier that the economy will continue to strengthen, going from a 2% rate of growth to closer to a 3% rate. And this is the first time that consensus analysts have all agreed that the economy will again expand at a more normalized rate of 3%. So that's a huge factor. It's not just us at Intermountain or LPL. It's major market technicians out there all kind of coming to the same consensus that we are going to have more of a normal growth pattern in the economy this year. What will that mean for the economy as a whole? Well, it'll mean that this is, by the end of this year, primed to be the 6th longest expansionary period in economic history. So the slide you're looking at today, or on the screen right now, shows all of the expansionary periods in the economy since World War II, all of the periods in which the economy was growing. You'll see the yellow bar in the middle of the screen shows the current growth pattern, and there are subsequent growth patterns that have lasted longer than our current, but we are in a position to exceed the 5th largest expansionary period, and that's a good sign. That means that again we're back to a more normalized pattern of growth, less technical and less volatile than it may have seemed over the past few years. During this expansionary period that we're experiencing right now, again the 6th longest today, that's all on the back of some fiscal drags that we've experienced. So this chart shows you over the past 3 years the components of growth within the gross domestic product in the U.S. All of the positive attributors or negative attributors to our economy growing. If you look at the red section in each one of these columns, that represents the government's portion of growth in GDP. And as you can see, the government has actually been a detractor of growth in the United States. And I think that's confusing for some people because people consistently hear about quantitative easing and the amount of money the government is pouring into the economy. Yes, they are. but they're doing that in the form of buying bonds or buying investment securities. They're not actually lowering taxes or increasing spending in certain components. It's actually the opposite. And so the reason the government has been a drag to growth over the past 3 years is that we've had tax increases versus tax cuts. We've had spending cuts versus spending increases. And all of these things in conjunction with each other actually slow the economy down. So one of the reasons that we're thinking this will be a better year in terms of economic growth is the government has already performed some of these exercises, for lack of a better term. And therefore, we won't see any tax increases this year. We won't see any sequester or any spending cuts, which means that the economy should, again, continue on a more normal growth pattern. So with all that in mind, let's take a look at some of the opportunities that we see in the market. Again, we do believe that stocks are going to have another good year. Again, not a banner year like last year, but a more normalized return pattern of, say, 10 to 15% on the S&P 500. We think that low interest rates and growing corporate earnings are really two of the biggest supporting agents of this thesis. We think that single-digit job growth and low inflation will also be proponents to a booming stock market. If you're wondering kind of where we go from a great year like last year, I think many people say, well, the market returned 30% last year. It can't possibly do that again, and we agree. We don't think that a 30% return is certainly on the front burner for this year. But what this chart goes to show is the years after a boom like we experienced, those good years or great years are often followed by good years. And so the years that we do have circled in this chart are the years after an expansionary period of more than 25%. So in 1998, for instance, we had a 26% return in the S&P 500. The following year, highlighted here, 1999, the market returned anywhere from 20 to 25%. So a great year can still be followed by a good year. We think that we have all of the good and growing fundamentals to support another good year in stocks. Don't let a great return last year scare you from staying invested in stocks this year. I mentioned earlier, another place to look for above market growth in the stock market are cyclical stocks. Those are companies like Caterpillar, John Deere, Procter & Gamble, some of the multinational or global companies that exist here in the U.S. These cyclical stocks are earners year in and year out. They're not interest rate sensitive like utilities or telecom companies. They're not defensive, or they're not as interest rate sensitive as some of these other sectors. We think that the companies like John Deere and Caterpillar that have the capital, that have the manufacturing infrastructure will continue to have good years, and we think that they'll finish above other sectors in the S&P 500. Flipping forward, we're looking also for a good year in small cap stocks. Small cap and mid cap stocks tend to outperform large cap stocks in a mature recovery cycle. And when I say mature recovery cycle, you're looking at probably years 3 to 7 in a cyclical recovery. And so large cap stocks tend to perform better in the beginning of a recovery because they're more stable, more cash flow positive companies. But small and mid-cap stocks tend to outperform toward the middle or late portions of a recovery because those are the companies that are smallest, most sensitive to economic change, most sensitive to lending, and now are funded, have the capital they need to continue growing their own operations. With a more confident consumer and a more confident investor, we believe small and mid-cap names will outperform large-cap stocks in 2014. We believe that emerging market stocks are in a good position to perform well in 2014. I would say last year most emerging market stocks either finished with a low single-digit return or possibly even negative. If you look at countries like Brazil or Russia, we believe that emerging market stocks tend to perform more like a small cap stock here in the U.S. Emerging economies are heavily dependent on the growth and profitability of developed markets like the U.S. or like the Eurozone, the UK, Japan. So as our developed market economies continue to strengthen, we actually aid or make emerging market economies stronger. So we think that off the hub of a bad year in 2014, we think that emerging market stocks are, from a valuation standpoint, very attractive and also in a great position to continue to grow this year. I did mention earlier developed market stocks internationally are also in a good position to grow. The Eurozone is coming out of a very similar recession as to what we had here in the U.S. Countries like Japan have also put in some fiscal policies and some stimulus packages to help their economy grow. And so we think overall international developed markets are also a good place to start to look. As a whole, the U.S. outperformed most developed markets across the country or across the globe. We think that this year the U.S. is likely to be in line or slightly behind stocks that exist in Europe or Japan, even Australia, in terms of developed markets. So let's look at parts of the investment markets that we think are mature or maybe a little bit more ripe for the picking. In terms of fixed income, you know that our overall consensus is somewhat bearish or negative on fixed income instruments. We think that rising interest rates and ultimately rising yields are negative and detrimental to overall fixed income returns. So we tend to be a little bit shy in investing in long-term bonds. We think that long-term bonds have an immense amount of interest rate risk, and we think that as interest rates tick up, long-term and even intermediate-term bonds are not going to be positioned very well to benefit investors' portfolios this year. Let's talk more about bonds. We think that if you're going to be in the bond market, intermediate-term bonds pose the best value for investors. Intermediate-term bonds are bonds with maturities between, say, call it 3 and 10 years to maturity. That intermediate-term part of the curve poses a little bit less interest rate sensitivity than long-term bonds, and still is able to provide investors with yield or interest rate cushion from long-term bonds. We think that the rates, the interest payments for intermediate-term bonds are very beneficial for investors. We think that'll help cushion or protect investors from any rise in interest rates. But I will say that intermediate-term bonds still pose interest rate risk. So as rates rise, you will see an adverse effect to intermediate-term bonds. So the next slide actually captures that graphically.
Patrick, we have one
Yes.
question. I just figured we could interject and answer this as we're going on, just to kind of keep this interactive. I'll pose it to you here. Can you speak to the significance of inventory growth as fueling influence on the growth we had in 2013, and then discuss the negative implications expected to impact for 2014, if any?
Yeah, I would say that inventory growth and ultimately corporate capital expenditures were certainly a tailwind for not only the economy but investment markets. I will tell you that inventory growth, although it was modestly strong last year, is actually lower than what we experienced in the 2 previous years. And that's typical for a recovery or a non-normal recovery like we're seeing today. Typically when you come out of a recession, as we did in 2009, 2010, companies have a little bit more capital, a little bit more cash flow to start to, for lack of a better term, stock the shelves, buy new equipment, buy new component inputs for their output product. We did see in 2013 a growth in capital expenditures and inventory replenishing, but really that was done modestly because of the headwind that Washington, D.C. posed on businesses, including tax increases, including a potential government shutdown, including the sequester. All of those things really made it hard for business owners to really put the full Monty down and grow their businesses. So we think that inventories were a tailwind last year. We think that capital expenditures and inventories will continue to be a positive for economic growth and stock market return.
That's great. Thank you, Patrick.
You're welcome. So flipping back to bonds for just a second, the wonderful world of fixed income. The chart you're looking at right now on the x-axis here at the bottom shows you that how each kind of maturity of bond would react to a rise in interest rates. So, for instance, if interest rates rose by 0.5%, you would see that long-term bonds would have a negative price effect, meaning long-term bonds would typically, on a price basis, go down between 1.5% and 2%. Intermediate-term bonds would post a very modest return. Short-term bonds would post a little bit better, but still modest return in the 0 to 1% range. Really what that means is the income that you get from these shorter maturity bonds will offset any price decrease due to rates rising. Now, if you look at a more steep rate increase of maybe 1 or 1.5%, intermediate term and long-term bonds will post negative returns if rates rise by 1 to 1.5% this year. They are partially offset by income received from these bonds, but the discount rate and the ultimate price of the bonds will fall precipitously if rates were to rise by 1.5% this year. We're skating on, for lack of a better term, thin ice on the bond markets. There is potential for modest upside growth. There's more potential or more fear of a decline or a decrease in prices in the bond markets. I flip forward to the next slide, high yield bonds and bank loans. We think that these are probably two of the more defensive sectors that you could be in within the fixed income markets this year. High yield bonds and bank loans all have higher coupon rates or higher interest rates than your typical U.S. Treasury or U.S. corporate bond. We think that those higher interest rates will help not only earn an investor some positive income off of those types of investments, but also help protect against that rising rate risk that we saw in this previous slide. We think that if we were to add high yield bonds into this slide, you would see high yield bonds actually post a positive return for a 50 basis point or even a 1% increase in rates. We think that if rates were to rise by 1.5 points, then the high yield bonds would actually turn negative as well.
I've got one more question, Patrick. I'm going to open up her line. It's Patty White. Patty, do you still have your question? Go ahead and pose it to Patrick if you'd like. Hey, Patty, we may have had her question answered. Continue on, Patrick. Sorry about that.
I'm a soothsayer.
Exactly.
Just to look at the price of high yield bonds, and I'm only going to spend a second on this, but high yield bonds are a little bit more expensive. We have seen an increase in popularity and investment in these types of securities, but we still think that with an interest rate between 4.5% and 5%, high yield bonds still pose a good sound asset class for investment in this next year. We think that if you're going to continue to stay in the bond market, aside from high yield bonds and bank loans, we believe that there's probably more value buying investment-grade corporate bonds. These are high-quality bonds from high-quality companies. This would be like buying a bond from General Electric versus buying a bond from, say, Chrysler. Typically, a little bit more sound balance sheets and corporate fundamentals, a little bit more cash flow from a company like General Electric, less interest rate sensitive versus something like Chrysler that has just come out of bankruptcy in the recent few years with a high amount of debt and a very low corporate rating. So if you're going to stay in the bond market, we think that investment-grade corporate bonds, from a safety standpoint, will pose better value than going into U.S. Treasuries or even more speculative names like the airlines or the motor companies out there. On a tax-free basis, we think that municipal bonds are in pretty good shape as well. You do have to continue to look out for sector exposure and regional exposure. For instance, you wouldn't want to buy a Detroit municipal bond at this point. You may not even want to buy a municipal bond that's in a automotive manufacturing area like Detroit. But where you might find more value in those municipal bonds are places like Utah or Pennsylvania or Maine or Florida. Places that have low tax sensitivity, that are growing economically, and that are not sensitive or subject to one particular industry or sector doing extremely well. We do think international bonds do pose some good opportunities. I would say on the forefront that international economies and international bonds are going to mimic a lot of what U.S. bonds have done over the past few years. There's a lot of government stimulus going into these foreign economies, and there's a lot of bond buying programs out there to try to keep money fairly cheap in these countries. So there is some emerging market debt that we do see attractive, but I would say on a whole, you've got to be cautious for investing in international debt markets. I'm going to wrap up here with a couple of real quick slides, and going back to the very beginning of our slideshow, and we mentioned we think improving investor confidence is going to be more based on corporate fundamentals than what Washington is doing. We think that Washington is going to be much less of a concern to investors this year than it has been in previous years. We think that a lot of the big struggles that Washington has been faced with have started to dissipate. We shouldn't see any more effects from the sequester. We shouldn't see any more tax increases at the corporate level or at the personal level. We do believe the debt ceiling, which is again coming due here in February, will again be lifted. So we think that there are going to be some tough decisions Washington has to make in the coming months, but it'll be less of a concern to investors as it has been in the past. And so I want to actually close with this next slide to show you that Washington and rhetoric coming out of Washington and some of the political nightmares that we faced over the past year did hinder the stock market, but in certain times, but the stock market was extremely resilient last year. And so we're actually looking at the growth of the S&P 500 over the course of 2013 in this slide. And look at all of the different scenarios or nuances or prohibitive events that occurred over the past year. And each time there was a slight dip in the S&P, with each time investors kind of pouring back into the markets. And they're not doing that because they want to gamble. They're doing that because they do believe the economy here in the U.S. is strengthening. They do believe that corporations have kind of shed or trimmed the fat and continued to grow their earnings and grow investor value. So just keep this chart in mind if I leave you with one thing, that we're going to see some volatility throughout this year. It's always prevalent in the markets. Don't let one or two little scenarios or nuances scare you out of investing because, again, the consensus is that the economy and the stock market will continue to have a positive effect on investors throughout the course of this year. Don't let little nuances kind of scare you out of the market. So with that, I'd like to open it up to questions. I know we've had a couple of good questions already. I'd love to entertain or try to address anything that's on your mind.
Yeah, I've got one typed-in question here I'll read to you, Patrick, then I got a couple other hands raised as well. This one, can you share your thoughts on the outlooks for inflationary pressures in the U.S. and likely changes for the next 2 years? I know this is something that's probably on a lot of people's minds, so great question from Lance. Absolutely, yes. Thank you, Lance. Inflation is always a concern, and what you'll find is that inflation up to this point has been very modest. It's been between 1% and 2%. Typically, you'll find over the longer term periods of time, inflation will typically gravitate between 2.5% to 3%. That's more of a normal rate of inflation as we're seeing today. We do expect inflation to remain tame throughout the course of this year. We do not think inflation is going to get back to a more normalized level of 2.5% and 3% because ultimately we do believe that with the Fed tapering starting to end, with the bond buying that the bond buying programs that they have enlisted in starting to wind down, we think less money will be invoked upon the market. And then we do believe that once the tapering ends, there will be a slow, albeit slow, steady withdrawal of the U.S. dollar from the economy. So these two factors in conjunction with each other should keep inflation tame, call it between 1.5% and 2.5% this year. Great. Thanks, Pat. And we also have a few of you asking if you can get a copy of the slides and charts. And absolutely, right after the presentation, for all attendees, we'll send out a copy of the slides, as well as our full 2014 market outlook based on the theme of the Investor's Almanac or Farmer's Almanac. So I'll make sure everyone gets that. I do have one more question from Don. I'm going to unmute his line and let him ask this one.
Thank you.
Don, go ahead with your question.
Thank you. Yeah. Just curious what you see a supply, how that may affect the economy.
I'm sorry, I didn't catch the very end of that. I'm sorry, Don, I didn't catch the very end of that question.
Is the Fed going to start worrying about
we're losing
Don. How might they deal with that?
Sorry, Don. I think we got a bad connection on your end. Maybe try it one more time, or else give a quick type the question if you don't mind.
I don't think Don's working out too well there.
Don, if you'd like to type that question.
I have it right here, Patrick. When will the Fed start to worry about supply constraints in the U.S.?
Yeah, that's a great question, and I think that ultimately what the Fed is looking at right now are two things, which they have been pretty pronounced in saying, and they're worried about unemployment rates and they're worried about inflation. And inflation is remained completely in check and completely aligned with their expectations. With unemployment rates slowly ticking down, I think ultimately their first concern is going to be how do we start to leg out of these monthly bond purchases that we're buying. And we've seen a $10 billion reduction in the amount of monthly purchases they're going to make. You can expect, it's our opinion that you can expect that rate to accelerate over the course of this year. And I think that at that point, when they're completely legged out of the bond buying program, they're going to stop and take a breather and start to take a look at what the low interest rate policy that they've had in place is doing to the economy, and ultimately how the markets have reacted. I don't think that the supply side of the economy is on the forefront of their radar at this point. I think that they're more concerned with how this tapering of the bond buying and ultimately this low interest rate policy will end up affecting investors over the course of this year. So that being said, you're going to probably see some more clairvoyance coming out of the Fed, probably more toward July or August of this year, when they've got a good half a year of data at hand. You probably won't see any real action in terms of addressing the supply side until maybe October or November of this year.
Okay, thank you so much, Patrick. Thanks to those of you who posed questions and for all of you for joining the webinar. We're looking forward to a fabulous 2014, and as usual, please reach out to us if you have any questions or suggestions, and we'll look forward to seeing you all soon. Thanks again. Have a great year.
Thanks, everyone.
Thanks, everybody.